Researching a stock or ETF, it doesn't have to be complicated. Today, we're breaking down the fundamentals step by step, and by the end of this video, you should have a good idea how to analyze both stocks and ETFs based on your investing style. Fasten your seatbelts, folks. This is going to be a good one. One of the biggest challenges for newer investors, and sometimes even experienced ones, is figuring out how to properly research an investment yep, you got it, before hitting that buy button. To make things even more complicated, the fundamentals you may care about, well, they can actually change depending on whether you're an income, a growth, or a hybrid growth income investor. We will be breaking this video into two sections. Yes, you guessed it, stocks and ETFs. I'm going to walk through what matters, what doesn't, and how your investing style affects the way you evaluate each one. Hopefully by the end, you'll have a simple, repeatable framework you can apply to almost anything you'll be researching, whether it's a blue chip stock or a high yield ETF. A sub to the channel can inspire your research with some future content. All right, we will begin with the basics when it comes to researching stocks. Whether you're looking at a bank, a telecom, a tech company, or a pipeline, the fundamentals you focus on will change depending on your investing style. Most people try to research using, well, more of a one size fits all approach, and that's where you may get a little confused. Income investors care about one set of fundamentals, growth investors care about something completely different. And those hybrid investors, they're kind of torn both ways, sitting there in the middle. Let's start with the dividend growth investor. When it comes to this style, your overall focus is on future expansion. You're looking for businesses that are getting bigger, stronger, and more profitable over time. Dividends aren't the priority, their overall potential is. Keeping that priority in mind, here are the fundamentals that matter the most. We're going to start with revenue growth. This is the engine of any growth stock. If top line revenue isn't growing, the story it tends to fall apart. Next, we have earnings growth. Revenue growth is great, but earnings growth shows whether that company can turn sales into profit. Ideally, both lines trend upward together. We also have valuation metrics like price to earnings, forward price to earnings, or maybe in some rare cases, price to sales. Growth stocks often look expensive, and that's actually okay. However, you still want the valuation to make sense relative to their peers, their growth rate, and of course, historical norms. We also have, and these are two of my favorites, return on equity and return on assets. So return on equity and return on assets, they show how well management uses capital. Higher is better, and consistency is huge for sure. Also looking at EPS trends, so earnings per share should show a steady upward trend. If their EPS is flat or declining, you definitely need to dig deeper to find out what's going on. Also, you guys have probably heard the word moat. Well, this is their competitive advantage. What you want to see is a company that has predictable, steady earnings year after year. It doesn't have to be spectacular growth, just consistent. Stable earnings usually means that the business is solid, demand for their products doesn't swing wildly, and they can comfortably keep paying you. So, in a nutshell, growth investing is about momentum, scalability, and long-term potential, and not current income. Let's shift into the world of income investing. And this is where things really start to feel a wee bit different. So if you're an income investor, you're not chasing the next hot stock or hoping something doubles in the next 6 months. You're looking for steady, reliable cash flow. You want companies that pay you consistently, ideally with dividends that grow over time, and you want those payouts to be backed by solid fundamentals. So here's what really matters when you're researching a stock for income. We will start with their dividend yield. The first thing most investors look at is yield, and that does make sense. It tells you how much the company pays you today based on, of course, its current share price. But here's the catch. A high yield doesn't mean a good investment. Sometimes a very high yield can be a warning sign that the market expects trouble. So for income investors, the question isn't how high is the yield, it's is the yield sustainable? And that takes us into the payout ratio. This is one of the most important metrics for income investing. The payout ratio tells you what percentage of profits a company pays out as dividends. Typically, 30 to 60% is very healthy. 60 to 80% is, well, that's usually the normal for many, many sectors. And once you get over 80%, this is where we enter into what I like to call the caution zone. As a rule of thumb, if a company consistently pays out more money than it earns, that dividend is likely on thin ice. Another great metric to look at is free cash flow, FCF. This one is huge, and it's overlooked by new investors. Basically, free cash flow is the money left after paying for all the day-to-day costs of running the business. And here's why it is important. Dividends come from free cash flow, not profits on paper. Company with strong, stable free cash flow can comfortably pay dividends. A company with dropping free cash flow, that's when those dreaded dividend cuts can happen. Also, another good thing to look at is dividend growth history. Income investors don't just want a dividend, they kind of want a dividend that grows. Look for companies that have raised their dividends for at least 5 years. So, one of those dividend aristocrats. 10 years is even better. And if they were raising their dividend during a recession or a bear market, that that's also pretty good, as it is another good sign of strength on the company side for sure. Now, another important thing is debt. You guys know I don't like debt that much. This one does matter more than most people realize. High debt makes dividends harder to maintain, especially in periods of, rising interest rates, slowing earnings, or economic uncertainty. Income investors want companies with manageable, well structured debt, not ones balancing on a financial tightrope. Also, earnings are pretty important, especially when they are consistent. When you're relying on dividend income, you want a company whose profits don't bounce around like crazy. Steady earnings usually means steady dividends. It doesn't need to be rapid growth, but it should be predictable. Companies that earn roughly the same amount year after year they're usually the ones that keep paying investors without any kind of drama. At the end of the day, income investing, it is all about reliability. You're choosing companies that can pay you today and hopefully pay you more tomorrow. So focus on the fundamentals that support that stability. Okay, now let's talk about hybrid investors, the investors who want the best of both worlds. You want income that pays you today, but you also want some growth that builds your wealth over time. And honestly, this group is growing fast because it offers the most balanced approach to long term investing. When you're researching a stock through a hybrid lens, the goal is, well, it's quite simple. Find companies that are financially strong enough to pay steady dividends while still having a little bit of room left over to grow. For you, your most important statistic will be total return. So that is the amount that share price has increased as well as the dividends that you've received. Hybrid investing, it's all about the complete picture. If a stock has a lower yield than a pure income pick, but strong term price appreciation, it might still beat out high yield names over time. So instead of asking, is the yield high enough or is the growth fast enough? You're asking, what does that total return look like when I combine both? You are also focusing on a sustainable dividend, not just high yield. Hybrid investors don't need the highest yield, they need the safest yield. You want a reasonable payout ratio, stable and rising free cash flow, dividends that grow steadily. A growing dividend boosts your income and supports long-term share appreciation. It's the double win. Okay, also, reasonable valuation. Hybrid investors, they sit in the middle, so valuation does matter a lot. You don't want to overpay or get trapped by a high yield value trap. What you do want is fair price, fair yield, fair growth. Nothing extreme, just strong fundamentals at a reasonable cost. Another important thing to look at is balance sheet strength because hybrid stocks often become foundational long term holdings. Financial stability is absolutely key. You want companies with manageable debt, consistent profitability, stable operating performance. Strong balance sheets allow the company to pay dividends today, invest for growth tomorrow, and most importantly, weather economic storms without cutting those payouts. It's all about, and I love this word, resilience. Another interesting one that I think is worth adding to this list is growth catalysts. Even if you love the dividend, you still want something that keeps the stock moving upward. And that can be, and this is where you may be looking at the news, some industry tailwinds, new markets, product expansion, any acquisitions they may have planned. Hybrid investors, they don't need explosive growth, they just need consistent, reliable growth that compounds over time. It's all about balance. You're not choosing between growth or income. You're choosing both. And now that we've covered how to research individual stocks, let's switch gears and talk about those exchange traded funds or ETFs. Because while stocks and ETFs share some overlap, the truth is the fundamentals you look at for an ETF are completely different. ETFs are built from dozens or even hundreds of holdings, and the structure, strategy, and fees all play a big role in long term performance. Now, we will once again begin with growth investors. When you're researching a growth ETF, your main focus is on long term appreciation. These are the ETFs that usually track sectors like tech, innovation, healthcare, or maybe a broad market index. So, speaking of an index, that's our top concern, index methodology. This one is huge. What index does the ETF track? Is it cap weighted, equal weighted, thematic? What does that ETF hold? How often is it rebalanced? How concentrated are the top holdings? Understanding the index and ETF tracks, and well, it's a very big part of understanding that ETF. Another good one to track is that long-term performance. Growth ETFs often have strong historical returns, but the key is the long-term trend. Look at the bigger picture, 3 year, 5 year, 10 year, and also total return. So price plus dividends reinvested. Growth, it's all about momentum and compounding. You've heard of it, not snowball. That's what we're looking for. Okay, sector exposure is also pretty darn important. Growth ETFs often concentrate heavily in a specific sector. High concentration can mean high potential, but also can also mean some pretty high volatility. So make sure the sector fits your risk tolerance and definitely beware of your diversification profile. A broader diversification is usually, in most cases, it's usually more ideal for sure. All right, let's talk a little bit about those fees. And the one we're mostly concerned about is that management expense ratio. This, it does matter more than people think. Growth ETFs are often held for long periods, so even a small MER difference compounds over time. Lower, lower MER equals more of your return staying in your pocket. Top holdings and weighting. So growth ETFs, like I said, they're often dominated by a handful of giants. You know them, the Magnificent Seven. If the top five holdings make up 40 to 60% of the ETF, then you're perhaps not as diversified as you may think. This can be good or bad. It just depends on whether you believe in those top names. It goes without saying, research the index, understand the sector, and check the performance and fees. Growth ETFs thrive on long term trends, not short term payouts. All right, income ETFs. Oh boy, this is completely a different world. Your focus isn't on high growth, it's on steady, predictable monthly income. So obviously, your first concern is going to be that distribution yield and how it's generated. This is the number one thing income investors look at. But the key question is, where does that yield come from? Is it dividends from underlying stocks, covered call premiums, return of capital, leverage? Not that surprisingly, two ETFs can show the same yield and yet behave quite differently. It's always good to know how that ETF that you're holding functions. The management expense ratio is also important for income ETFs, and well, they often have higher fees, especially covered call or leveraged ones. But that's not necessarily bad. You just want to make sure that the ETF earns a lot more than it costs. That's kind of your bottom line. Distribution frequency and stability. This is also an important. You want to know how it's paying. Is it monthly, semi-monthly, quarterly, maybe weekly, somewhere down the line? Is that payout stable, or does it bounce around? Has the distribution ever been cut? Income investors, for the most part, require, well, a level of predictability, especially if you are retired and you're living off of that income. You don't want it all over the place. Covered call strategy, we'll give it its own category here. So, if the ETF uses covered calls, you want to look at a few different things. You want to look at the overwrite percentage, potential upside loss, volatility of underlying stocks, and whether calls are actively or passively managed. Covered calls boost income, but, and we all know this, they do cap some of that growth. All right, another important thing is NAV behavior. So NAV, that is your net asset value. This is huge for income ETFs. If the NAV steadily declines because the payout is too high, that can be a red flag. If that NAV holds steady or grows, that's fantastic news for sure. Also, sector concentration. Is that ETF heavy? Diversification may feel like it's not as important with an income ETF, but it can still be important for sure, especially if you want to maintain a steady level of income. Now, I will point out income sectors do behave differently. You want a good match for your overall portfolio. Just don't chase yield. Understand how that ETF generates income and whether the NAV can support it long term. Finally, we have the growth income investors. Our hybrid strategy tends to want a mix of steady income and, of course, long-term upside. Luckily, there are a lot of ETFs that fit this bill if you look for them. So, like stocks, our number one our number one metric is going to be total return. So the increase in the value of that ETF as well as those dividends. That will hopefully give us a very nice number. So, like with the hybrid stocks, total return is, well, it is everything. A lower yield ETF that grows 8% per year can easily outperform a 10% yield ETF with a decreasing net asset value. Distribution sustainability. Hybrid investors, well, they don't need the highest yield, just a reliable one. So we're looking for, and this is going to sound familiar, consistent net asset value or NAV, stable payout history, sectors with long-term growth potential. These are all very important. Next, we've got the strategy type. Not all ETFs are equal here. Hybrid investors often gravitate towards low to moderate covered call ETFs, dividend growth ETFs, broad market ETFs with strong underlying growth, enhanced yield without excessive decay. You want a mix of stability and momentum. Diversification and overlap. Hybrid portfolios tend to be long term, so avoiding unnecessary overlap matters more than it does for income investors. Check if your ETF duplicates stocks you already own, other ETFs in your portfolio, sector weightings you're already heavy in. Hybrid investors want exposure that aligns with their risk comfort. Look for ETFs that balance income and growth without swinging too far in either direction. Total return, as I said, it is the ultimate judge here. At the end of the day, researching a stock or an ETF doesn't have to feel overwhelming as long as you understand what you're actually looking for. Phew. Okay. Ah, that was a lot of information. However, let's boil this all down. At the end of the day, researching a stock or an ETF doesn't have to feel overwhelming as long as you understand what you're actually looking for. Growth investors, income investors, and hybrid investors all value different fundamentals. And once you choose the lens that fits your style, everything else becomes much easier. For stocks, growth investors focus on expansion and momentum. Income investors focus on payout, safety, and cash flow. And hybrid investors look for that balance of stability and upside. For ETFs, it's all about understanding the index, the strategy, the fees, and how the fund actually delivers the returns you're expecting. Once you know how to evaluate those factors, you can You can research almost anything with confidence. Well, let's continue that learning journey by checking out this interview with the CEO of Evolve ETFs. Thank you for watching, and I will see you in the next video.